Everybody is talking about it. Rockets, billionaires, headlines, a stock market launch that feels bigger than gravity itself. The SpaceX IPO hype is not just a market event, it is a psychology test. And the real question is not, should I buy? The real question is, can I think clearly when everyone else is losing their mind? In this video, we are going to break down 3 lessons from the SpaceX IPO hype. Lesson 1. Price is not the same as value. Lesson 2. A great company can still be a dangerous stock. Lesson 3. Smarter investors do not fight FOMO with opinions, they fight it with a process. So before you chase the rocket, let's check the fuel, the engine, and the price tag. Because in investing, excitement can make you feel rich before a single dollar is earned. And that is exactly where mistakes begin. Welcome! Today, we are not here to worship the hype, we are here to understand it. And if you stay until the end, you will get a simple checklist you can use for any hyped IPO. Not just SpaceX, any IPO that tries to hijack your emotions. Let's start with the obvious. SpaceX is not an ordinary company. It has rockets, satellites, global ambitions, and a story that feels like science fiction becoming normal. But this is educational content, not financial advice. The goal is not to tell you what to buy. The goal is to help you think better. Because IPOs are designed to create emotion. Scarcity, urgency, celebrity, vision. FOMO, which stands for fear of missing out. And when those forces combine, even smart people can make impulsive decisions. The market does not reward excitement alone. It rewards cash flows, competitive advantages, discipline, and patience. So let's turn the hype into a classroom. Lesson 1. Price is not value. An IPO price tells you what buyers are willing to pay at launch. It does not automatically tell you what the business is truly worth. That difference can make or break your returns. Imagine 2 people buying the same amazing company. One pays a reasonable price. The other pays a fantasy price. Same company, very different outcome. That is why valuation matters, even when the story is incredible. A great narrative can explain why a company is special, but only numbers can help you decide what price makes sense. When an IPO dominates the news, people often skip the numbers. They say, "This company is the future." And maybe it is, but the future can be real and still be overpriced today. Smart investors separate the business from the stock. The business can be revolutionary, the stock can still be vulnerable. Why? Because price already contains expectations. If expectations are sky high, the company has to deliver sky high results. Good results may not be enough. The market may demand extraordinary results. That is the trap of buying hype without valuation. So before buying any IPO, ask one question. What has to go right for this price to make sense? If everything has to go perfectly, you are not investing. You are hoping. Hope is not a strategy. A strategy has assumptions, limits, and a margin of safety. Margin of safety means leaving room for being wrong. Because even the best companies face delays, competition, regulation, and unexpected costs. If the price assumes perfection, one small disappointment can hit hard. So lesson 1 is simple. Do not ask, "Is this company amazing?" Ask, "Is this company amazing at this price?" That one extra phrase can save you from expensive enthusiasm. Now let's talk about the second lesson. Lesson 2. Do not confuse a great company with a low-risk investment. Space exploration is inspiring. Satellite networks are exciting. Reusable rockets are impressive. But investing is not a movie trailer. You do not get paid for being impressed. You get paid when future results exceed the expectations already baked into the price. And with famous companies, expectations can become enormous. The brand can become so powerful that investors stop asking hard questions. Questions like, how durable is the moat? How profitable can the business become? How much capital will it require? What can go wrong technically? What can go wrong commercially? What can go wrong politically or legally? These questions do not make you negative. They make you prepared. A hype-driven investor says, "I love the company." A smart investor says, "I understand the risks." That difference matters, because risk is not only the chance that a company fails, Risk is also paying too much, too soon, with too much confidence. Confidence feels good. Overconfidence gets expensive, especially when the crowd is cheering. Crowds are powerful because they make uncertainty feel like certainty. But markets punish false certainty. The smarter move is to build scenarios. A bull case asks, what if everything goes better than expected? A base case asks, what is a realistic path? A bear case asks, what if the story breaks? If you cannot explain the bear case, you do not understand the investment. That does not mean you avoid all risk. It means you choose risks deliberately. Great investors are not fearless. They are risk-aware. And that brings us to Lesson 3. Lesson 3. Defeat FOMO with a process. FOMO does not ask for permission. It appears suddenly, usually when the price is moving fast. Your chest tightens, your brain speeds up, your rules disappear. That is why you need rules before the hype arrives. Rule 1. Define your maximum position size. If a stock can emotionally dominate your day, your position may be too large. Rule 2. Write down your before you buy, not after, before. Because after you buy, your brain becomes a defense lawyer. It starts protecting the decision instead of judging the evidence. Rule 3. Decide what would make you change your mind. Slower growth? Weaker margins? Higher competition? Governance concerns? If nothing can change your mind, you do not have a thesis. You have a belief. Rule 4. Separate watching from buying. You can admire a company without owning it today. Sometimes the smartest trade is no trade. That sounds boring, but boring can be profitable. FOMO wants speed. Wealth wants patience. And patience is easier when you know your plan. Let's build a simple IPO checklist. First, what does the company actually do? If you cannot explain it simply, slow down. Second, how does the company make money? Revenue is the oxygen of the story. Third, what are the margins today, and what could they become? Growth without future profitability can become a beautiful problem. Fourth, who are the competitors? A strong company still lives in a competitive world. Fifth, what risks are clearly disclosed? Do not skip the risk section because it looks boring. That boring section is where the ghosts live. Sixth, what valuation is the market asking you to accept? And seventh, what is your exit plan if you are wrong? Notice what this checklist does. It slows you down. And slowing down is a superpower in a market built to rush you. The faster the crowd moves, the more valuable your pause becomes. That pause gives you space to ask better questions. Better questions lead to better decisions. Better decisions compound. And compounding is how ordinary investors become extraordinary over time. The SpaceX IPO hype is exciting. It should be exciting. Big innovation deserves attention. But attention is not analysis, and popularity is not protection. A famous company can fall. An unknown company can surprise. The market does not care how much you admire a story. It cares about what the business delivers versus what the price promised. So here's the mindset shift. Do not be a fan of a stock. Be an analyst of a business. Fans cheer. Analysts compare. Fans chase. Analysts calculate. Fans need to be right today. Analysts can wait. That is how you become a smarter investor. Not by predicting every move, but by refusing to let hype make your decisions for you. So remember the 3 lessons. Price is not value. Great companies can still be risky investments. And FOMO is defeated by rules, not emotions. If this helped you think more clearly, subscribe for more smart investing lessons. And before you chase the next rocket, check the price of the ticket.